Good morning. Cameras on, please. So we are going to today, again, as I mentioned, go over some loose ends. No new stuff I talk about today will be on the exam. There will be some stuff where I refer back to stuff we did already learn. And I'm hoping we'll get through sort of 4 topics today, but it'll be a pretty light coverage, but these topics are also practically important and interesting. So pay attention. You don't have to write anything down if you don't want, but you should pay attention. And then, as mentioned last class, we're going to, on Monday, I'll do a review. And then on Wednesday, we'll go over exam questions. I'll post exam questions by the end of this week, by Friday, close of business on Friday, on TWEN. Any questions about the rest of the semester or the exam? Okay. Well, the first topic we're going to talk about is receiving a partnership interest for services. We've talked about receiving a partnership interest for property, section 721 and 722 and 723 and 704C all come into play when you have a partnership interest received for property. But what if you receive a partnership interest for services? So we'll make this a little bit more interactive since we need to keep people awake. So you receive a partnership interest for services. Can someone tell me what is the general rule when you receive property for services? This goes back to tax 1. What are the tax consequences you receive property for services? Any volunteer?
Is it ordinary income?
Equal to how much?
The amount of property you got.
The fair market value of the property you received. So you go back to tax 1, if you recall that you receive property for services, you have compensation income equal to the fair market value of the property you receive. And you have a basis equal to that fair market value as well. And that makes sense. It's just like your employer paying you cash equal to that fair market value, and then you buying that property from the employer. So we have the same tax consequences when you receive cash as when you receive property. And that kind of has to be the case, because if you tax property receipts more favorably, then we would encourage employers to pay employees with property. So that's the general rule. Property for services, that's a taxable event for the service provider. And they may have an issue with liquidity, right? Because if you receive large amounts of property, value of property, you can't pay the government with property, you got to pay the government with cash. So you may have some liquidity issues in that context. What if you receive, and this that you learned, everyone learned in tax 1, what if you receive what's called unvested property for services? So unvested property is property where you don't get to keep it unless you work for the employer for a specified period of time. So if you were to go work for Google, for example, Google might pay you what's known as restricted stock. And maybe they sign you, they'll give you a bonus. They'll say, here's X number of shares of Google stock. However, if you quit within a year, you got to give them all back. If you quit after 1 year, but before 2 years, then you got to give 1/4 back. And so on and so forth. And then finally, after you've worked there 4 years, all the stock has vested, and then you can quit and keep the stock. Does anyone know what the tax consequences are when you receive unvested property like that? Some of you that maybe took the tax and timing course with Professor Watson would have covered that. I might have alluded to this at some point, but it doesn't really get covered. Anybody want to take a stab at it? Okay, well, hearing no volunteers. So the general rule there is, this is known as section 83 of the code, deals with unvested property. And the rule there is that the general rule is you don't have tax until the property vests. So in essence, this tax law sort of holds the transaction open until it vests. And then when it vests, you include the then existing fair market value in ordinary income. So in the Google example, you wouldn't have any tax consequences until 1 year, in which case one fourth of your Google restricted stock vests. You determine the Google value at that time of the 1/4 value you included in ordinary income at that time. And then you get a basis in the Google stock equal to that value. So any subsequent appreciation or depreciation would be capital gain or capital loss. So you await vesting. On the other hand, with unvested property, you can make what's known as a Section 83B election. And you can say, basically, well, ignore the restriction. We'll tax it just like it has no restriction. In which case, you would include the Google value stock immediately. And the 83B election is a complicated election in terms of whether to make it or not. I mean, the benefit you can see is that it converts future appreciation to capital gain because you're sort of locking in the compensatory element on day one. But you're also accelerating tax. And so you have that kind of trade-off that you have to think about. Notice also that with Google stock, you don't have a liquidity problem because Google stock is highly liquid, right? You can sell part of it if you need to pay the tax, or you can borrow against it quite easily. A bank will lend you money against it because it's so easy to value. If it's a private company, you got restricted stock is more problematic, or any stock grant is more problematic if it's large, because you might not be able to sell or borrow against the private company stock because it's so illiquid. So in that case, with private companies, they'll usually use stock options to compensate instead of restricted stock, because, and I won't get into stock option taxation here, but stock option taxation, you generally don't have a tax consequence until you exercise. And exercise is a voluntary act, and so you can await exercising your stock options. If you got stock options, and trying to think what's the next one, like WeWork is going public through a SPAC. If you got stock options in WeWork, you could await exercising your stock options until it goes public, until after it goes public, or you could await until there's somebody's coming in to buy the stock in an offering, in a round of financing. So it's sort of elective, voluntary in terms of when you trigger the tax. But with restricted stock, generally the vesting schedule is time-based or performance-based, and it just happens. And when it happens, you've got your taxable event. So that's the general rule for property transfers for services. And the term property is defined quite expansively for this purpose. The 83 regs, which cover this topic, say property is everything, all property, except for what we call unfunded and unsecured promises to pay in the future. So that just means if your employer just says, I will pay you X dollars in the future, but it's not backed by anything, it's not secured, there's no funding of it. It's just what we call a mere promise to pay. Mere promises to pay are not property, but everything else in the world is. And so once you look at it that way, you might say, okay, well, partnership interest for services, we know how to tax it. Well, there's been a lot of controversy over a type of partnership interest as to whether it is property, and it's called a profits interest, and that's what we're going to talk about mostly today. A profits interest. So a profits interest is a partnership interest where you receive an interest in future profits, only future profits, if and to the extent they materialize. You don't have an interest in existing capital. So in other words, if you receive a profits interest and immediately thereafter the partnership were to liquidate, you'd receive no distributions because there's been no profits. You get no share of profits. The partnership has no profits, so whatever share you get is a percentage of zero, and so you get no distribution. So we distinguish profits interest from a capital interest. A capital interest is one where you do have an interest in existing capital. And so That's a big difference. Now, everyone agrees that a capital interest in partnership is property and subject to the rules we just talked about. The debate has been, what about what they call a mere profits interest? And the origin of the confusion is because there's some rules in the regs under section 721 that imply that profits interest is not taxable. There's valuation issues about how you would value a profits interest. And there's a thought that it's just better to tax profits interest not as they're granted or vested, but just when the profits do materialize, let's just tax them when they're allocated. So that's been the debate, and there were some cases, and the IRS challenged and won some and lost some, and ultimately the IRS drafted a procedure, a RevProc, RevProc 9327. It's known as the safe harbor. And what this safe harbor says is it says that the IRS takes the position now that it will not challenge the tax treatment of profits interests as a non-taxable event. So if you receive a profits interest for services and you report it as non-taxable, which you invariably will, then you don't have to include anything in income immediately. Of course, when you get allocated profits, then you will include income then. And then that was supplemented because, well, let me show you an example. That's very abstract, so let's take a look at an example. Let's say A and B contribute $100 of cash each. And these are just capital accounts I'm putting up there. And they go out and they buy land for $200. Okay. Land then goes up in value to $400. And then they decide, you know, we're going to hire C as a service partner. And C is going to receive a 20% profits interest. Because C is going to take this land and do whatever it's going to do with it, run a parking lot. Let's make it simple. And C is going to be the manager of it. So C is going to get a profits interest. And so this is a little review. So when C gets admitted, C's not contributing any property or cash. And so basically look at the capital account maintenance rules that we looked at. You get capital account increase when you contribute cash or property, not when you contribute services. So C's capital account is 0. But we're also going to book up, because C is being admitted as a partner. We know that that's a permissible book up event, and we're going to want to book up the land to fair market value. So we book it up to fair market value. That results in 200 of book gain. And so we'll give A and B, because they're each 50-50 partners before C, they give each of A and B 100 of book up. So the capital accounts after C is admitted look like 200, 200, and 0. Everybody agree? And by the way, that's a hallmark of a profits interest, a 0 capital account. And we know it's a profits interest because if we sold the land the next day, we would have 400 of cash, and it would go 200 to A and 200 to B, and C gets 0. C has no interest in existing capital. Only to the extent the land is sold for more than 400 does A get a distribution. And the book up, by the way, is what ensures that that C doesn't get a distribution. If we didn't book it up, if we just failed to do that, then if the property were sold for fair market value, there'd be 400 of proceeds and 200 of gain, and C would get 40 of that gain, right? Because C gets 20% of the gain. So if you fail to do the book up or fail to specially allocate the gain, it would screw everything up. And among other things, it would give C a windfall, but it also gives C a taxable event. So the book up here is what ensures that C doesn't receive a capital interest. And by doing that, because it ensures that A and B are receiving exclusively the existing value in the business. By the way, if we had goodwill on the books here, if this were an operating business, we would also book up goodwill from 0 to whatever value it exists before C enters. All right, everybody understand? Any questions on this? So then let's just see how the profits interest operates. Let's say eventually the land is sold for 500. So the land is sold for 500, we'd have 100 of gain, and it would be allocated 20% to C and 40% to each of A and B. So A and B is each taxed on 40, C is taxed on 20, and then if we were to liquidate, we would have 500 of gain, 500 of cash, and it would be distributed 240, 240, and 20. And that's how the profits interest would work. And so the taxable event for C is going to happen here with the allocation, and it's going to be closely related to a distribution. We talked about, and in a lot of cases, once the property is sold, then the cash is going to be distributed, but the proceeds of the sale will be distributed. But even if not, again, we talked briefly about minimum tax distribution requirements, that there will be a requirement for the partnership to distribute at least some percentage of each partner's positive allocation to allow them to pay the tax. So we see what the profits interest did is it took the taxable event from grant. And again, it's an unusual treatment because usually we say, look, if you receive something valuable for services, we tax you now on that value. And the fact that it may be hard to value, maybe easier to value later on, that doesn't really matter. We do our best and we tax you on it now. So that's one thing that this profits interest treatment allows, is deferral. The taxable event here is occurring upon the sale of this property, not upon the grant. We know that deferral of income is good. Another impact is going to be the character. And this is really what comes up to in private equity and venture capital and carried interest. A carried interest is a profits interest that's received by managers. It's generally, we use carried interest in the context of these private investment funds, venture capital funds, which are investing in startups, private equity funds that are investing in more mature businesses, and hedge funds, which are investing in generally publicly traded stock and securities. And the managers are generally entitled to roughly, it's negotiated, but the benchmark is a 20% carried interest, is 20% profits interest. So tax lawyers say profits interest. Investment folks say carried interest. If you're in the real estate business, they call the 20% the promote. It's all different words for a profits interest. But if this character here is a capital asset, which it would be in the case of a private equity fund and a venture capital fund and a hedge fund, they're all capital assets they're investing in. And a real estate, if it's an investor fund, if it's a dealer fund, then it's ordinary income property. But if it's an investor fund, then it would be capital gain, and this gain would be capital. And that's another big benefit, because C is working, is sweating for the money. When you sweat, figuratively or literally, for your money, you pay ordinary income. That's the way our tax system works. Not here, though. You didn't have the ordinary income event at grant because of profits, interest, safe harbor. You don't have the ordinary income upon the sale, because why? Because this is the gain, the 100 of gain is characterized at the partnership level, and the partnership is holding this as a capital asset. So this is a capital gain, and when it flows through to the partners, the character sticks to the item as it flows through. And just the operation of the partnership rules say, if the partnership realizes capital gain, and you're a partner that gets allocated a portion of that, you have capital gain. And that's that capital gain, that conversion from ordinary income to capital gain for service providers, plus the deferral of tax from grant or vesting of the interest to eventual sale of the underlying property. Again, for venture capital, private equity, it's going to be the sale of the company that they invested in. Is the carried interest a loophole, right? Folks that refer to that as a loophole. It seems to be a loophole in the sense that it doesn't seem to be part of the grand design of the tax system to have everyone in the world, everyone in the U.S. who sweats for their money, pay ordinary income, except for, private equity titans and venture capital folks and real estate folks. It's just kind of an accident of history that this is the way the partnership rules work, and nobody's ever gotten around to sort of closing it. There have been attempts to close during the Obama years when the Democrats had control of the Senate and the House and the presidency. There were real momentum to close it. And the way to close it is, it's not as simple as it looks, but you could just basically turn off that rule that says character determined at the partnership level and say, well, except for if you get allocated capital gain for your services, that'll be, now we'll change that, and we'll turn that off, and we'll make that ordinary income. So there was a proposal, Section 710, what would be Section 710, to fix this loophole treatment, this carried interest treatment, but it never passed the Senate because anybody know why it never passed the Senate, even though the Democrats controlled it, the Senate? Anybody want to speculate? Take a guess as to what was the big holdup? Well, New York Senators, Schumer, didn't like it. Why? Because a lot of the titans of industry who benefit from carried interest are New Yorkers and other people who donated large amounts of money. So that is as it exists now, we have the carried interest treatment. The interesting thing will be with a 50-50 Senate and groundswell of support to getting rid of this, will this succeed? These private equity folks in particular are very politically powerful. Any questions or comments on any of this stuff? So in the 2016 campaign, Trump railed against carried interest and said it wasn't fair. And again, you got to keep in mind that a lot of the people that benefit from this are some of the richest people in America, right? Are earning hundreds of millions of dollars a year, but paying tax rates. Famously, Buffett, who also benefits from this, but not because of private equity. Just Buffett doesn't get paid a lot, really. He just gets paid. He gets richer when his stock goes up, but he famously said that he paid lower tax rates than his secretary. because again, the cap gains rate is 23.8% max. So Trump railed against it during the campaign, and during that Tax Act, there was some momentum to do something. But what they ended up doing is they ended up saying, okay, if the gain, this asset would have to be held for more than a year to get the long-term capital gain treatment. They basically extended that minimum holding period to a 3-year period. So as long as this land were held for at least 3 years, then C gets long-term capital gain. If the land were held for less than 3 years, then C's allocations would be short-term capital gain, which is generally short-term capital gain, is taxed as ordinary income. So that was the fix that was put in there. Two problems with it, or at least two problems with what they did. Number one, in the private equity venture capital context, you're typically not going to dispose of your assets within 3 years. I mean, they buy the company, they do some things, and it's not unprecedented to have a disposition within 3 years, but it's unusual. So most of their assets will be seasoned long enough so that 3 years doesn't make a difference. Second problem is that it was hastily drafted, and it's got like 10 different ways to avoid it. So no one really pays this tax, even if you want to dispose of something within 3 years and you couldn't delay. Any tax lawyer worth his or her salt will find a way to avoid it. And so it's really ineffective. It's window dressing legislation at its finest. One interesting thing to note here is that Susan Collins was making noises about, Susan Collins, a senator from Maine, was making noises about strengthening this provision and extending and making it, instead of a 3-year holding period, make it like a 10-year holding period, which that would really affect private equity and venture capital. Sort of the sweet spot for selling your portfolio companies is going to be something like 3 to 7 years out. And a private equity fund, venture capital fund, it's only supposed to really last 10 years in total, although oftentimes the terms get extended for a year or 2 or 3. But 10 years would really do something, assuming it had teeth. And there's a ProPublica report that came out recently, actually before the 2020 election, that showed that she was making all these noises, and then she got a big campaign contribution from Steve Schwartzman, who is the CEO and founder of Blackstone, which is a big huge private equity company. And that after that, she was no longer, there email trails where they were trying to figure out where she stood on that. And the email that they got back was that she's no longer pressing for the 10-year holding period after the campaign contribution. So it's a good illustration of why this carried interest treatment has been difficult to kill. Any questions or comments on any of this stuff? All right, let me talk one other thing. Let's say C's profits interest is unvested. So C's profits interest is unvested. And that kind of makes sense if you think about it, because if you give C a profits interest that's vested, that's fully vested at grant, the C could like work for a day and then say, you know what, I'm out of here. I'll go sit on the beach in Hawaii, and if this property appreciates, then I'll participate in it. So they say to C, okay, C, you get a 20% profits interest, but you've got to work for at least, let's call it 2 years. You got to work for at least 2 years. And then in 2 years, it's going to vest. And then let's say in 2 years, the property is worth 300. So again, the property is worth 200 when C comes in. The property is worth 300 when it vests. And we'll say it's worth 400 when it's sold, like as consistent with before. So under Section A3, as we learned that we don't tax C, we don't treat C as receiving the property until it vests. The problem is when it vests, C doesn't look like it has a mere profits interest anymore. Remember, if we liquidate the partnership when the property vests, when the partnership interest vests in C, now the land is worth 300. If we sold the land for 300, then C would be allocated 20 of that gain. I actually think yeah, right. But let me go back. I'm going too fast. So the land went up to 400 before C is admitted. So we got the book up again. And C's capital count is 0. But then let's say when it vests, it's worth 500. So when it vests, it's worth 500. And then let's say when it's sold, it's worth 1,000, let's say. So it vests at 500. To test for a profits interest, we would say, okay, when it vests, if we sold the property for fair market value, would C receive a distribution? And if we sold the property for fair market value, we'd have 100 of gain. It'll be allocated 20 to C and 40 to each of A and B. That's what we showed before. And so C would receive a distribution, and C no longer receives a profits interest if we apply the general rules of Section A3, which is we basically pretend the property wasn't transferred until it vests. So it has moved from a profits interest to a capital interest because the property appreciated and C gets a share of that appreciation. So that was a problem. And so the IRS issued another revenue ruling that said, okay, when you have unvested profits interest, doesn't matter, we're going to test it, profits interest status, when it's granted, and doesn't matter when it vests. So C still gets a profits interest here, and the fact that it's unvested doesn't matter. The fact that when it does vest, it is morphed into a capital interest is irrelevant, and C still doesn't have any tax on grant. Let me also just say, so that revenue procedure is 2001-43. Again, you'll see this in practice if you practice in this area. It won't take you very long until you'll see this. But that's what tells you that an unvested profits interest is still treated like a grant of a profits interest and subject to that same rule. Tax lawyers will, in addition, advise C to make an A3B election when he receives an unvested profits interest. Even though this revenue procedure says that he doesn't have to, there are some bells and whistles there that tax lawyers get nervous about. And the whole point of this was really to avoid C making an A3B election, which requires him filing a piece of paper with the government. But tax lawyers using a belt and suspenders approach and being highly risk averse still advise C to file an A3B election, sort of what they call a protective A3B election, so that even if they fall outside the safe harbor, they then don't have a taxable event on vesting. So again, really nice tax treatment for receiving profits interest. Again, you get deferral. That's nice. You get potential character conversion. That's nice. You also, even if you, leaving aside deferral and character conversion, you still time the taxable event, the allocation of income, with liquidity, generally a distribution of cash. So profits interests are vastly preferred over capital interests. So we're going to turn to capital interest now. But any questions about this deferral, this unvested piece? Okay, let's do a capital interest. Okay, so let's say same facts, but now you get A and B each put in 100. They buy land, and let's say it goes up to 300 to make the math easier. We'll see. So it goes up to 300, and then C is admitted. But the deal here, A and B will stay to C. So you get 1/3 of the partnership. You get a 1/3 interest in profits and capital. So if the partnership were to liquidate the next day, the A, B, and C would each receive $100 because the land has gone up to 300 and C is getting a 1/3 interest. So that's a capital interest because C receives an immediate distribution if there were a liquidation for fair market value right away. And so that would mean that C would have to include the value of that capital interest in income. So that'd be $100. And then notice C has no cash, right? C has a partnership interest worth 100, but no cash. So that creates that cash crunch that makes it not very attractive for C. Although C is getting a better non-tax deal, right? Because C is getting a 1/3 interest in everything, or instead of a 1/3 interest in mere profits. Again, you can kind of make that up economically by just saying, okay, we're gonna get a higher percentage in the profits than you would get as a capital interest. But the tax rules here is that C would have 100 of income and C would get 100 of capital account. So you'd still book up. So we book this up to 300. And effectively, C is treated as receiving 100 of cash from the partnership and then contributing it to the partnership. And then A and B are each treated as making a payment, or the partnership is treated as making a compensatory payment, a guaranteed payment to C. So C would have ordinary income and A and B would have ordinary deductions. And the capital accounts would end up at 100 each. And that's capital account treatment. And again, that's whether, if it was unvested, then the taxable event would occur on vesting instead of grant. But the reason why we don't see it in practice very much is exactly this, is that the service partner is now going to have a taxable event, either on grant or investing, and is not going to receive a distribution of cash. You're not necessarily going to receive a distribution of cash that is going to allow C to pay the tax. So capital interest, immediate tax for the service partner, deductions for the other partners, but due to liquidity problems, generally, if this were the deal, tax lawyers would generally come in and say, you know what, let's give C a profits interest, and we need to give C a greater than 33% profits interest to make up for the fact that C is receiving 100 less of current capital. That's fine. We can sort of do it that way. Instead, otherwise we end up with a tax problem. And having it be a profits interest also sort of aligns with incentives. I mean, the idea of a profits interest is let's incentivize C to make this, to create profits. And so giving C a chunk of profits is incentivizing, whereas giving C a chunk of capital is not so much incentivizing, because capital's there, whether profits exist or not. Okay, any questions on profits interests, capital interests? So what you'll see in practice is going to be a lot of profits interests and not capital interests. All right, the next topic we're going to talk about is allocations. So again, this will be a nice review. So we learned in class, spent a lot of time on allocations of tax items, income, gain, loss, deduction. How do those items get allocated to the partners? And we said that in general, you will determine the allocation under the partnership agreement and test those allocations for safe harbor treatment. If they're generally be substantial economic effect safe harbor. And if they're non-recourse deductions, you'll test them under the 704-2E safe harbor. So the partnership agreement tells you where the allocations go. and then you test under these safe harbors, and all the safe harbor requires certain things. We know you have to maintain capital accounts according to the capital account maintenance rules, and you have to, at a minimum, liquidate in accordance with positive capital balance accounts. So liquidating distributions have to be made in accordance with capital accounts. And then we have deficit restoration, or your QIO and that sort of stuff, right? But we need to, at a minimum, have capital account maintenance and liquidate according to positive capital account balances. And that safe harbor, what's nice about it is it gives you a bunch of rules that if you meet it, you know how the IRS will, well, you know that the IRS will respect your allocations, right? And some of it is very formulaic. We know substantiality in some cases can be not so clear, but at least you have a sort of a way to get comfortable that your allocations will be respected. So that's the good news for that approach. We can call that the safe harbor approach. We're making allocations in accordance with the safe harbor. Tax lawyers will also refer to that as the layer cake approach. I think it's because, you know, your capital account, your liquidating distribution is built kind of like a cake. It's like your capital contribution, and then you increase it by your allocations of income. So you're sort of building a cake. I'm not sure that's exactly the origin of it, but that's what they use, layer cake. I haven't quite figured out why. The problem with that, and we've called it the safe harbor. So I just say, if you hear layer cake, they're referring to allocation, what we call an allocation driven partnership agreement, where the partnership is going to say, this is where the allocations go, and then we're going to liquidate according to capital account balances. The problem with that approach, one problem with that approach, is the liquidate in accordance with positive capital account balances. Number one, well, and think about it, the clients have a deal in mind, a business deal in mind, and they want to make sure that the partnership agreement accomplishes the business deal. And typically, the deal is going to be thought of in terms of cash in and cash out. Who has to put in cash, and how much, and when? And then once we have distributable cash, operating cash flow, or proceeds from sales, where does the cash go? That's what the business people are focused on. That's the business deal. Cash in, cash out. And that cash out is really important, right? That's how people make money, is through the cashing out. And so in terms of the non-liquidating distributions, it's pretty easy. There'll be a distribution section in the partnership agreement, and it'll tell you where the cash goes. And once the cash goes somewhere, it's going to reduce capital accounts. And then on liquidating distributions, in a layer cake or a safe harbor style agreement, it's going to say liquidating distributions are made in accordance with positive capital account balances. And so two problems with that. One is the business person who's looking at the agreement is going to say, okay, does that comport with my understanding? Now I have to figure out what the capital accounts are going to be, and whether they're going to be consistent with the deal, or whether if the capital accounts are going to say something really strange and therefore require liquidating distributions in a way the parties don't anticipate, right? And then related to that is that the capital accounts, the allocation provisions have to be drafted well. Because if you screw up the allocations, again, screwing up meaning you're doing it differently than what the parties anticipate, then you end up with a situation where the liquidating distributions will be made in a way the parties didn't foresee, and you'll have winners and losers out of that. Just a small anecdote there. When you have this layer cake approach, I've given talks on this topic, one of the guys, a pretty esteemed partnership tax lawyer, told me that the one way to illustrate this is that he tells his litigators, So if you're litigating a dispute involving an LLC or a partnership, you need to hire a tax lawyer to interpret the deal, to interpret the provisions, because only a tax lawyer will understand the capital accounts adjustments and the requirement to liquidate and how that'll be. And so and in many cases, the parties don't understand what the partnership agreement actually says. And so that's the problem right there, is that it's hard to figure out what it's saying. It's hard to ensure that the allocations are going to make sense ultimately. And so the clients won't like it if they don't understand it. The second part of that is that if you're not a tax lawyer, if you're not a partnership tax lawyer, it's pretty stressful to try to figure out whether the allocations are going to be right. And so then you're put into a situation where you either have to hire a partnership tax lawyer as part of the deal, or you're going to tell your client to sign something that you don't really understand, and you can't really explain to your client. So all of that has combined to create a trend away from the safe harbor layer cake approach and towards what are known as target allocations. And target allocations are basically going to depart from this approach of trying to be in the safe harbor and say, we're going to focus on the distributions. We're going to say where the distributions go. And we're going to say current distributions go this way and liquidating distributions go this way, and no longer sort of liquidating according to positive capital account balances. And what's the beauty of that? The beauty of that is that the business client, the client, can understand the distribution provision. They know how distributions work. That's, again, when they think of a deal, they think of where does the cash go? Who gets first dibs on the cash? What happens if it's profitable? What happens if it's not? Where does the cash go? That's what they think about. That's how they think. So they can read a distribution provision and be confident that it's what they want. Likewise, the business lawyer who's not a partnership tax expert also can make sure that the liquidating the distributions make sense. And so you've gone apart from it. One downside is it doesn't technically comport with the safe harbor. So you're not outside the safe harbor protection, and you're into the partner's interest in the partnership, the old PIP test, the old facts and circumstances test. But in a business deal that is driven by distributions, again, if you're thinking about distribution, you're not making this a tax play, then there probably shouldn't be that much problem with using it, right? So if you're not motivated by taxes in your business deal, then all the concern that we had about allocations really goes by the wayside, and they should be respected by the IRS, but there's no guarantee of it. Let me show you a typical targeted allocation language. So I just pulled this up on the internet. So let me go right here. So here is a typical target capital allocation. And so, and again, instead of in a layer cake, you'd see profit and loss allocation, and you would see, losses allocated this way, income allocated that way, and so on and so forth. Here, you just say net profit and net losses of the company for each fiscal year shall be allocated to the members in a manner that causes the capital account to equal the amount that would be distributed upon a hypothetical liquidation of the company for book value. So you're going to hypothetically liquidate the company for book value at the end of the year, and you're going to compare that to the starting capital account, and the difference, you're going to plug the difference as income or loss, as the case may be. And so instead of the distribution following the allocations, which is what happens with liquidating distribution, now you're going to have the allocations follow the distributions. And then in liquidating, here's your liquidation provision. instead of liquidating positive capital account balances. And when you liquidate, you're going to pay your creditors, of course, and then you're going to distribute according to the business deal, which here is a preferred return to certain members, then certain members getting back their capital, and then here's a carried interest to other members, and then whatever's left to Class A members. This is the business deal. This is, again, what the business people can understand, and it's going to be also what the general business practitioner or lawyer is going to be able to understand. And again, available cash gets distributed this way, whether it's liquidating or non-liquidating, and we can be sure there's not going to be a surprise on liquidation where the money is going to go somewhere it's not intended to go. So let me show you an example of target, how this would work. So let's take another simple example of A and B and C. We've got A and B each contribute 100, and C is getting a profits interest. So it gets no capital contribution, and they invest in something for 200. And let's say the deal is that B is going to get a 10% preferred return. So that means the first $10 of income goes to B, because that's 10% of his undistributed capital. A is not going to get a preferred return, even though A is contributing cash. Again, we might say, well, why is that the case? Maybe B is guaranteeing the debt, or some other reason. B has a big name, but for whatever, B is getting a better deal than A. And C is going to get a 20% profits interest. So whatever's left after the preferred return, C gets 20% of it.
Are you supposed to be sharing your whiteboard with us?
Oh, am I not sharing the whiteboard? Yep, thank you. Now, can you see?
Yeah.
Okay, so yeah, A contributes 100, B contributes 100, and C contributes 0. We've got this asset that's worth 200. And then let's say the partnership earns $100 in year one. So we got $100 of cash. So that 100 of income, again, here we'll do the layer cake approach, the safe harbor approach. What we'd do is we'd have a provision and say, okay, we have $100 of income. How does it get allocated? Well, 10% return to B. The first $10 goes to B. Then we got 90 of income left, and it's going to be allocated 20% to C. So that would be 18. And then what is that? That's 82. That would be 41 to A and B. So that's the preferred return. And this is the remaining. It's not right. That's 100. So it would be 90 minus 18 is 72. So it'd be 36. So the capital accounts would be 136, 146, and 18. And so this would be the allocation. And the agreement would specify, again, say the first 10 to B, then the rest split 20, 40, 40. Right? And we'd liquidate according to positive capital account balance. If we were to liquidate, that's how it would go. Under the targeted capital account approach, what we would do is we would say, okay, we wouldn't have an allocation provision per se. We wouldn't say how it's allocated. We would say, okay, what you're going to do is figure out how the cash would be distributed if we were to liquidate for book value. And where would it go? And we would have this 300 of cash. And once you run through what we just ran through, we would say that A gets 136, B gets 146, and C gets 18. Again, the distribution will say that the cash gets distributed, the first 10% to B, then A and B get their capital back, then A and B and C will split 40, 40, 20, and you end up with the same answer. And so the hypothetical liquidation results to this, and then you just plug the difference. And then you say, okay, we start out with 100, we get to 136, so it must be plus 36, plus 46, and plus 18. So we end up in the same place. Of course, it has to be. But again, two advantages. One is we can understand this because, again, this is going to be driven by the distribution provisions. And two is we don't have to worry that we screwed up our allocations. And this is a pretty simple allocation structure, but you can see, you can imagine in more complicated structures, it might be tricky. And so you just plug the difference here. So that's target. Again, you're sort of working backwards and you're sort of saying, okay, we're going to figure out where the distributions go and then reverse engineer the allocations to make it fit. Instead of the layer cake approach where you're going to start with your capital contributed and adjust by your allocations and then distribute based on that. So it reverses. What are the problems with targeted? They get into some weird consequences we're not going to get into here. Number one, potentially some weird results. You're not in the safe harbor. So you lose that protection. You can't, within targeted, especially allocate certain flavors of income. Again, you're just cash is cash. And so you can't say your any gain from the sale of this asset goes to A instead of B. And so you can't play some of those shifting games that we know you'd have to get through the substantiality safe harbor. But then again, if you're not playing the shifting game, then you're not really trying to be abusive. So that's why, in a sense, your targeted allocations are not tax motivated. And then finally, you end up kicking the can to the accountants who are filing the return to really figure out where the allocations go. So the lawyers write this language. Let's go back to the language. They write this pretty simple language in the agreement, and then they're done. They don't really have to worry about how allocations go. They don't have to explain how allocations go. And so you kind of kick the can to the accountants who are then going to do this analysis and then figure it out. Are they going to do it correctly? It's not laid out for them as it was in the layer cake safe harbor approach. Now, on the other hand, a cynic would say that even when it is laid out for them, that accountants are using this approach to figure it out anyway, that they're not really reading allocation language. They're trying to understand the business deal and trying to make allocations that make sense. And so you may be back to where you started. So anyway, bottom line is you see more and more targeted allocations. You'll see a lot of them in practice. They do have advantage. Again, the advantage is you don't have to be a partnership tax expert to understand what's going on. They do have disadvantages, but it is popular. Why don't I teach this stuff? You know, there's really nothing to teach. Because again, it's not the lawyers who are doing the intellectual work to figuring out the allocations. It's really the accountants. And in order to understand why people do this, you have to understand the safe harbor. So I think the safe harbor is more important to teach rather than target. So we won't see target, of course, on the test, but you'll see out there in practice. Any questions on that? Okay, let me just talk quickly about Section 199 Cap A. So let's turn to section 199 cap A really quickly. This is the pass-through deduction. It's famous as the pass-through deduction. I'm sure you have heard about it. I'll explain to you why I didn't teach it. And it applies to partnership income, all flow-throughs. It applies to S-corp income. It applies to sole proprietorship. So if you have a sole proprietorship, no entity or a single member LLC is disregarded, it applies to that income. So it applies pretty widely. And basically, the history of this is that Congress substantially cut the corporate tax rate from 35% to 21% in 2018. And that was done almost exclusively for international competitiveness reasons. The US rate was higher than the other tax rates, much higher. And so that was thought to hurt multinational corporations that were that are US companies. And so to provide the competitiveness, to reduce the anti-competitiveness, I guess, or to make the US companies more competitive, you reduce these rates. And it also reduced incentives to shift income to other countries and the like. We know it didn't work that well because part of Biden's big thing is to sort of continue to sort of tinker with the international tax system. But that benefited corporations, but it doesn't benefit, flow-throughs. And flow-throughs tend to be your closely held. Again, if you wanted to sort of generalize and be pretty accurate, you could say that your huge businesses are your public companies, your corporations, and your small businesses are your flow-throughs. So the flow-throughs got nothing. And so then there was pressure, particularly Ron Johnson in Wisconsin, to say, well, you can't help out, the General Motors and Microsofts of the world and not help out, mom and pop. And so we'll help out mom and pop. We'll give this pass-through deduction. And what it does is it says, subject to certain bells and whistles, it says, basically you're only taxed on 80% of your income. So instead of being taxed on 100% of your pass-through income, you're taxed on 80%. So another way to say it is it reduced the tax rate by 20%. So instead of a 37% max rate, once you run the numbers, comes out to something more like a 28% tax rate, 29% tax rate. And probably they should have just reduced the tax rates just by that. But, what it left out are like wage earners. So if you're an employee, you're not a sole proprietor. You're not a Schedule C. You're not filing Schedule C. You don't get the pass-through deduction. So wage earners don't get it, but if you're an independent contractor, you do. If you're a if you're a pass-through owner, you do. So it creates this sort of weird situation where your wage earners can get taxed at 37% and your owners of the business get taxed at 28, 29%. That's kind of bizarre. So that's the general gist of it. There are some bells and whistles. Congress wanted to limit this to some extent to businesses that are capital intensive. And so there's a carve out. Well, and these carve outs, by the way, only apply when you get above a certain threshold of income. So below a certain threshold, the carve outs don't apply. So the thresholds are like 300,000 to 400,000 for married. The thresholds are sort of gradually phased in. For unmarried, it's half of that. And so some people, if you're below that level of income, you don't have to worry about these thresholds. But one of the things that gets kicked out above those thresholds, you have to have a trade or business, but you can't. What gets kicked out is a specified trade or business if you're above certain thresholds, and then your trade or business of being an employee, your wages are out regardless of what your income is. So a specified service trade or business is kicked out. There's a cross-reference to 1202 as to what a specified service trade or business. You all will be interested to know that law is a specified trade or business. So you're out as a lawyer unless you're below the income thresholds where you're back in. So if you have a law firm partnership and you're married and you have more than, again, about 400,000 of taxable income, you're out. You don't get any 199 Cap A benefit. And other sort of service businesses are kicked out. So you get in some weird situation. Again, if you're a law firm partnership, and let's say you are an employee, let's say you're an associate of a law firm, you don't get the benefit of 199 Cap A. You're an employee. You're out. You don't get the benefit. If you're a partner of a law firm, then you could get the benefit if you're below the thresholds. So think about like a junior partner who makes a married person with taxable income of less than 300,000. Well, now you do get the benefit. Then you become a senior partner and now you're making more money and now you're married, your taxable income as a married couple is more than 400,000. Now you're back out. And there's other thresholds that come in, again, above, there are other bells and whistles that come in above the 300, 400,000 threshold that I'm not going to get into. Why don't I teach this? I could. I'm not convinced it's going to be around very long. I wasn't convinced when it started. It's inordinately complex. It's really hard to justify. And I suspect that it's going to be removed or substantially eliminated. Again, I could see it remaining at the lower levels, at the middle class, maybe upper middle class, but I think the big chunk of the benefits which currently go to extremely wealthy people who are invested in partnerships, it's going to go away. So to avoid the pain of going through it for no good reason, I decided to skip it. So, and I won't test you on it. And I will also have an assumption or an instruction to ignore Section 199 Cap A. Because it would technically come up in a lot of the fact patterns we're doing, because we're going to be dealing with partnerships who have income, but you get to ignore it for the exam. Hopefully, I'm not a big fan of 199 Cap A. Hopefully, that'll comport with the actual law pretty quickly. Any questions on 199 Cap A? Okay, the last thing I want to talk about is self-employment taxes. So when you have income from services, if you are an employee, you have employment taxes. They're paid half by you and half by your employer. If you're self-employed, so you're an independent contractor, then you have self-employment taxes and you pay both sides. What about if you're a partner in a partnership? Well, the general rule is if you're a partner in a partnership, that any income that flows through to you, ordinary income, is subject to employment taxes. So not, obviously capital gains and dividend income, that's not subject to self-employment taxes. That's not self-employment income. But everything else is, if you're a partner, and it's consistent with this idea of partnership as an aggregate, that if you're if you own a law firm individually, all the law firm's income is your self-employment income. If you join together with another partner, you're each treated as owning that law firm individually, effectively, and therefore you report all of that income as self-employment income. There's a limited partner exception to that. Congress wrote in and said if you're just a limited partner, then you're not subject to self-employment taxes. And that provision was drafted in the context of when before LLCs. And before LLCs, a lot of partnerships would have general partners. They were the ones who did the work. And limited partners, those were the silent partners who just contributed their capital and sat on the sidelines and waited for the money to come in. And so it made sense in that context. If you're a limited partner, you're not doing any work, you're not being employed, you're not performing any services, so you shouldn't pay employment taxes on it. It's investment income. So that's the limited partner exception. The big problem comes in, and then after Congress writes that, LLCs come in. And LLCs, you're a member of an LLC, you have limited liability, you're a limited partner. Are you not? And so there's been case law about what constitutes a limited partner. And in general, the courts and the IRS view if you're a service, if you provide services, even though you're an LLC member with limited liability, you're not a limited partner. You don't get the benefit of that. You end up being taxed on your share of the income for self-employment, for employment tax purposes, which is once you get above the Social Security threshold, you end up at about 3.8% is what we're talking about. Now, let's contrast really quickly with an S corporation. So now you're doing your flow-through business through an S corp, and an S corp is an entity. It's no longer an aggregate, treated as an aggregate. And so now if you work for your S corp, you're an employee of your S corporation. So your S corp will issue you W-2 wages. Remember, you can't be an employee of your partnership, just like you can't employ yourself. You can't be an employee of your partnership. But an S corp is the fiction that it's an entity. It's a separate taxpayer. And so the S corp hires you. So you're the shareholder and the wager and the employee. And under those rules, only the wages that the S corp pays you are subject to employment taxes. Any income that's allocated to you of the residual profit is not wages, nor is it self-employment income. We don't have that same aggregate theory. And so one thing you'll see out there is a lot of S corps in the service business. S corps have problems that we've talked about and alluded to in this class. There's no like 752 corollary to S corps. It's harder to, there's no tax-free distributions of property in S corps. So S corps can be problematic in certain respects, but in a pure service business, those issues aren't problematic. What's the advantage? Well, the advantage in a pure service business, you can sort of set your wages and pay yourself a set amount as wages, and the rest will come out as an allocation, a distributive share, and then distribution from the S corp. And if that's respected, then you're only paying self-employment taxes on your wages and not on the residual profit. Whereas if the same business is held in a partnership, you'd pay taxes on the full employment taxes on the full amount. This is known as the John Edwards or Newt Gingrich play, depending on your political persuasion. Edwards put his legal malpractice business in an S corp. Newt Gingrich put his speaking business in an S corp. And they paid themselves relatively low wages out of the S corp, and then the rest of their income was flow-through income. So Edwards paid himself about $300,000 a year in wages, which is not a small amount, but relative to his income, which was roughly $10 million a year during that time, the other $9.7 million came out free of employment taxes. And so that's just a very common play. The trick is just you want to set the wages at a high enough amount that the IRS won't challenge it. If it's too low, the IRS can challenge it. But if it's too high, then you're losing the benefit. And so Edwards picked an amount, he defended it. You can defend it by pretty much saying there's probably not another lawyer in North Carolina at the time that was making $300,000 of fixed income, guaranteed income every year. So he was paid quite generously, but certainly you could argue that he should have paid more on self-employment taxes. But again, everybody sort of does this in the service business. So you'll see a lot of law firms and other professional service businesses set up as S corps. And you might wonder, given all we talked about in this class about how partnerships are sort of better than S corps in many, many ways, here's one way they're not, which is a treatment. And it's not an income tax issue, it's a self-employment tax issue. So that is that. Any questions on that? All right. Well, next week we'll do the review on Monday, exam questions on Wednesday, and exam questions will be posted by close of business on Friday. So I'll see everybody next week. Have a good weekend. Bye-bye.